You know you're bad when you call during the webinar. See, you gotta know better. I appreciate this opportunity. Let's talk risk management. Yes, indeed. If I touch music at the fingertips, I wish it would start back playing that easy. That would be great. I appreciate you all so much. How you doing, Miss Davis? King Hollis is in too. Let me hit that record button so we'll have this in our library as well. Thank you so much for sharing your Wednesday night with me. This is AfroEconomics Live, and we're talking risk management tonight. Risk management, how to protect yourself, your assets, everything. You know, risk management. Yeah, we don't even really, think about it as much as we should. But I know that all of the members of AfroEconomics know one of the first things that I do is to do the risk analysis. So definitely I am a serious believer as an investment advisor that it's very important to get an understanding of your risk level. And it's so interesting when you do the risk analysis and then you tell me your score, and then I look at what you're doing and how you're investing, and when it's so far from what you want, but it makes it so much more valuable, and the most depressing one, I would say, that is when the person really is willing to allow their money to grow. Like their risk score says, I want growth. I want my money to grow, but they're not allowing it to grow. Like they're being, way too conservative. So I would say that one thing that we need to keep in mind, right, Ms. White? Ms. Sadie White just logged in. The party don't start till she walks in. Now the party has started. That we have to consider when we're thinking about risk management is that you can be too conservative. So it is risky to actually not give your money the opportunity to grow. So it is actually risky when your portfolio is not positioned in a way that's going to allow you to maintain your style of living, or your lifestyle choices are not going to allow you to maintain your style of living. So definitely, it's important to have an understanding of risk management and not think that risk only comes into consideration when you're afraid that it's going to go down because you're being too aggressive. You also should be aware that not having your assets positioned for growth, at least to outpace the cost of living and the impact of taxation and things on your future, is also allowing yourself to be at risk. So I use strategies like portfolio diversification, asset allocation, and even rebalancing to assist me in effectively managing risk for my clients and members. And I also, bring in insurance as it's needed to cover risk as well. And so, so like there, even like life insurance is an easy one to think about. But life insurance for you is really not as important when you're thinking about yourself, because you'll be gone. In order for life insurance to truly activate, you'll be gone. So, but there are opportunities for having coverages that, like having long-term care coverage, that would fall under an insurance product. including annuities into your portfolio mix. That's an insurance product. So, where do these things come in and how they impact your risk score? So the risk management is not anything that we should be taking for granted, because it's the process of actually identifying where you are on the scale of risk. So I use the algorithm and the risk analysis portal to get your score, and that allows me to identify it. But as I get to know you, I know how true that is for you. So that's where artificial intelligence mixed with your advisor really pays off. Like sometimes we think that, oh, the computer can just do everything, but that's not true. If I take a computer score and I don't know you, for many people, that score is not you. It's just that when you did that, you were not really understanding its impact on your portfolio. Like there's everything. It's kind of like taking the SATs. You can't determine that score. It's not going to tell you really for sure if that child will succeed in higher education or not. And the same thing is with anything that a computer will develop on you, even your credit score. It doesn't really tell that if that person, with the 850 score will actually, never lose their job, because they could lose their job and you gave them credit based on that 850, but they lost their job or, God forbid, a disability. More people have to file bankruptcy due to a disability than a job loss, because if your health is okay, you can get another job. So, and that also would be risk management on how to cover, a disability even. So it is my job to help you cover uncertainty that exists in all of our life, all of it, and how cover to some degree, that we can find things that will help you cover the risks that are just involved in life. So I want to think about some key areas where I want want you to think about. Now, we have to, as many of you have businesses or are a business owner or have real estate property, or and you're renting out and things like that. Well, that's where it becomes very important to separate your business from your personal assets. Because if something in your business happens and someone goes to your rental property and they fall down, and they want to sue you, that business property, that business use, needs to be separated, from you. And those are things that I want us to continue, to talk about, how to minimize risk that you'll be exposed to. And I have a member that I'm talking with that now, because she's doing some contracting with the government, and it involves housing in her properties. So my thing is, make sure we need to see what type of liability coverage the government is giving you for housing the people for them in your property. If not, we need to get additional liability insurance coverage for you to protect your personal assets from that business, a business loss. Because when people decide to sue, they're coming for wherever the money is. So, but if you make a point to separate the business from your personal assets, you could consider, incorporating, especially as it grows and as you have additional liability, the limited liability company doesn't really cover you enough. You would need to, have that limited liability company has to be a separate entity, because a LLC could actually be a sole proprietorship, which would not be a separate entity. But those are the things that we talk about on Fridays during our business network, on Fridays at noon. But so let's make sure that you realize that in risk management, you want to know that if you start, and many people do that, they'll, have a house, and that's their, and they just put someone in that house, but they never really think, they just think about the insurance on the property, but think about, how do I protect myself from any liability that may happen in there also. So the any accidents that might happen, and how am I personally liable for things, or how have I protected myself from what might happen? Because as we're growing your assets, you're becoming wealthier and wealthier personally, where you may actually have more personal assets than you have in liability coverage for it. So a big part of risk management is for us to look into umbrella insurance, and getting an understanding of when it's time to have that umbrella insurance. And I think that we really don't take it seriously, because when people get sued personally for something that happens at business, it doesn't make a news story. You don't really think about it, but that's where, having a financial advisor in your life, that's where having membership, pays off. That's why I'm always encouraging us to talk regularly. Like, don't jump up with these surprises, like, oh, I started this, I did this, or I did that, very rarely is that a pleasant surprise, because I could have helped you with some things. And I know it's like, often things are done without talking, it through with me, because it's like, if I talk to her about it, she's gonna make it complicated, but I'm only making it complicated because I want to protect you. I'm only wanting to make sure that I treat you the way I would want to be treated in that situation. I need someone, to watch out for me. That's why I want to watch out for you. Last week when we were talking about if I should die before I wake, I spoke briefly about joint accounts, and here also, the risk management, like being careful with joint accounts, because if you have an account with someone and they get sued, they're coming after, that account. I mean, it literally, if your spouse, or if you have a joint account with your spouse or joint account with anyone, if they get sued, the entire account can be wiped out by the people they owe, or, so be, conscious, of that. The as well as, like, issues that might have, you might be trying to help a elderly parent get housing, and you have a joint account, you put them on your account or something. Well, now, that counts as an asset that they may really not have. It could be just yours, but you put them on it. So now it's considered jointly theirs as well. So, we have to think these things through. Risk management, like, is a part, like a big part of, our financial planning process. I also have found that there's a push to encourage people, not to do retirement plans and, at work. Like, they'll say, don't do that plan, at work. And I think that that is, some seriously foul advice. And I always want to see, like, if someone told you that you should not participate in the plan at work, I would like to see in writing why they think that you should not participate in a plan at work. And in most situations, people are losing out on a company match because they decided that they would have to pay taxes on it 20 years from now when they pull it out. So that, person advised that, you should set this up, with me. So, because then, basically, they're not looking out for your best interests. Because setting up a retirement account at work from a risk management perspective it helps you. Your retirement account at work is protected from bankruptcy. It's protected from, any type of creditor that starts trying to look after, come after your money, as well as rollovers from work plans. If you set up a rollover IRA with me, for example, those assets, because they came from work plan, are still, supposed to be protected from bankruptcy and protected from lawsuits from creditors and things like that. But the safest place, still, if you have legal problems, just like, ask OJ Simpson, not to like call him out or anything, but he still has his NFL pension because it cannot be taken from him because of that lawsuit. So, that's a definite, it has the ERISA, ERISA, ERISA qualified retirement account, protection from lawsuits and bankruptcies and even civil lawsuits. So so definitely, and like I've seen it written that the non-ERISA, like the traditional IRAs, have the bankruptcy protection, but the question is, can they withstand an actual lawsuit? That's the key. Like, so, better safe than sorry. If you got legal problems, that work plan can protect you till you get those out of the way. And consider investing in the umbrella, insurance, getting an understanding of it. I can help you through that using the existing insurance that you have. When we analyze the policy, we'll get an understanding of, do you need to have the large liability coverage, which is called umbrella insurance. And it covers your vehicle and your homeowners, any liabilities that happen with that. And then we may need to also look into the business insurance and what type of business liability are you exposed to and what type of coverage do you need. And then in many cases, the business liability coverage is a lot less, is not that expensive. And then, as a rule of thumb, or, something to keep in mind, if your net worth is over $500,000, then, umbrella insurance can become more valuable for you. So if this kind of pops out to you, and remind me in our next meeting that let's look at your homeowners and vehicle insurance and, think about the possibility of, do I need to have the umbrella coverage? If you have umbrella coverage, we still need to do an analysis on it. And often we're able to discover things and that you can come back and save money on that. And if ever needed, I can definitely also help you get quotes to with additional companies to help you save money. Many times we just lock in with the company that you've always been with, and that's, often not a good idea. Don't just get in the auto renew and forget about that we need to analyze that regularly as well. In the in knowing, and I kind of spoke of this as we started, like how to get to know your attitude about risk, and talking it through, increasing your knowledge about the volatility of different investments that we have, like that we could do. I need to make sure that you understand the difference between the individual stock volatility versus if we're using an ETF portfolio volatility, the difference in the risk level, and the what is, and understanding that if this is a big portion of your portfolio, it has a lot more impact on your overall life. If it's just a small section of your, overall portfolio, and you have like 90% of your assets, are very conservative, putting the other 10% in the most aggressive option on the planet is really not going to make that much difference in your risk level, because you are dominating it with, but it also means that if the growth portion, that 10% does do well for you, it's not going to really be able to help you as much as it could have if you had a bigger portion of your portfolio in growth investments that did well. And the key word there is that they have to do well in order for it to really be something that you regret not putting more in. So you have to make the risk worth your while. And often I've seen when I'm analyzing an existing portfolio and I'm giving them suggestions on what it should be like, I can see like that when you're taking on greater risk and your average annual return has been lower than the new portfolio that I'm suggesting with a lower risk level but higher performance. So it just means that the new portfolio that I'm developing for you is working more efficiently. You're getting more dollar out of the risk that you're being exposed to. As I was saying, like sometimes you think, oh, I'm being conservative and that means that it's low risk. Like, no, like sometimes people think just because it's a bond, all bonds are conservative. No, a high yield corporate bond, it can have a risk score as high as a blue chip stock or even higher. So definitely don't assume anything. Make sure that you have an understanding of everything that you're investing in, and that's the joy of working together. So understanding your investments and understanding your risk of each attribute, each part of your portfolio. So another part of risk management that I shared at the beginning is that rebalancing. And rebalancing is if we decide that we want to have a 80% equity stock exposure and 20% bonds, and that all of a sudden the bonds portion does really well, and you end up with a 60% equity and a 40% bonds when we evaluate it, 3 months later, then rebalancing would mean to sell off the 40%, like the sell down back and then use that 20% overage from the bonds and use that to purchase stocks. So that it doesn't mean that we have to do that, but we at least need to know that your portfolio balance has changed because of market conditions. But I suggest only rebalancing when it's necessary, when it's because that's the way you really want it to be, that you want to have the 80% equity and 20%. But if you say, no, I like this, but it's at least understanding that that rebalancing allows you to buy the portion of the portfolio that is now out of favor at basically a cheaper price. You're buying the ones out of favor at a cheaper price, and you're selling the winners to buy what's on sale. You could look at it that way. No, but rebalancing is a risk management strategy. And then also dollar cost averaging. And we haven't talked about this lately, but dollar cost averaging is when you're investing the same amount of money each month. Like that's what you do, when you're doing, say, the $50 each pay period or $100 or $1,000 each pay period, that it helps you manage risk in uncertain times when there is no certain times, right? But you're investing these smaller amounts of money in regular intervals, and that it's allowing you to, when the market is high, you're getting less, units for your dollars. And when the market is low, you're getting more units for your dollars. So it's considered, you're averaging out the average cost. And you're sticking to, I'm buying more even though the market is down. Like, and sometimes people like, well, the market is down and I'm afraid. But in reality, for a long-term investor point of view, that's the time that you should be going in, as long as you know that you have a good portfolio. So if we've set up a good portfolio asset allocation across the asset classes, and then, the market is down because of interest rate changes or a pandemic, or, that should consider sticking to your long-term plan and being able to accumulate more because of the market volatility. You're benefiting from it by sticking to your goals through the bad times. And then also, like, don't ignore a risk management technique. Like, don't ignore that it is important to have some safety in your portfolio. Now, I can appreciate that when the market is doing great and you look at your decisions to protect your amount of money that you need to always have. And then you say, well, if I had invested that, I could be doing a lot better. And I can appreciate that. And that's a pressure that I have to have as an investment advisor. But that I know that my desire to make sure that the clients are not exposing themselves to too much risk also sometimes means they miss out on some opportunities. But it's more important to me that you sleep well at night than that we're constantly chasing the highest return. So I want to make sure that I go, like, how much do you need to make sure you always have? That we need to have secure. And then that above that, like, what makes you feel good? Like, so no matter what the market does with the volatility of the other investments that we're doing, you have this. So, realizing that we need to take some steps to have safety, for that portion of money, I have to accept that's a very important, part of my philosophy that I want to protect. I want to make sure that you're not stressing about, I mean, I can't take out all the stress, but I don't want you to be stressing unnecessarily. We want to have managed smart risk. That's it. Nothing unnecessary. And then also one way to, like, not have to sell big portions of your portfolio, when the market might be down, is to make sure that you have the liquidity that you need, that you have the money that you need, to pay for the next 6 months already available to you in cash, that it's liquid. So we don't have to worry that we have to sell, to take care of this short-term need. So, because keeping, cash on hand is extremely important risk management, strategy. So, and I want to make sure that before you leave me, that I allow you, if you want to ask me a question about tonight's topic, Bonita, make sure, let me know if there was something that I said that, that stood out to you, please let me know before you go. I wanted to make sure that I have this package for you that, sometimes I get, we get into our conversation and I don't get to make sure that you have at the front of this library, our library, the information that you need on this risk management discussion, using insurance, analyzing your insurance, looking at your portfolio, understanding that risk analysis quiz. Like, if I gave you the risk analysis quiz and now you're like, you know what, I need to do that again. We do need to do it every 6 months anyway. Like, there could be some sort of change in your life, or you might now have, a lot of money, and you need to make sure, you don't need to have to worry about, this in the next 10 years. And things, something, it may have changed for you where you don't need this to be available. So if it's a long-term desire, then the money, you could allow it to have more growth. And in reality, you shouldn't be as concerned about short-term volatility when your goal is for long-term money. Any specific questions?
No, I think you do a good job of explaining that when you talk to us individually,
Great,
but I think your overall explanation is great of what you're saying right now.
great, great. I'm not, I'm sure you could appreciate that sometimes, like when you have security, and then the market is doing great, and then you go like, you know what I mean? Maybe I shouldn't be secure. You know what I'm saying? It's like really hard
Yeah.
to, to feel like you're not missing out. But if I know, because I've been doing it so long and you've been working so long, that it sure as will feel like we're missing out. You know what I'm saying? The market will correct, and you're like, whoa, I'm glad that that I didn't overdo it. That having the proper, growth, risk exposure, security, and everything like really makes a difference, especially in challenging times. Right?
JB,
Yeah.
I just
Mhm.
want to point out that you and I, we've looked at my account, my work 401, and what really bothers me about Fidelity is they tend to put on my account all the time that I am too aggressive. And I'm like, really? Am I
That's great.
supposed to be in this to
So,
make money or what?
exactly. Exactly. Send me a picture of that next time, because what happens is they probably have old information on you,
Mm,
and they didn't do a new analysis on you. So they're going based on what we think we know about you. You know what I mean? That's why we
mhm,
keep saying that. But
mhm.
you are, or they're also trying to sign you up for their investment advisory services. And then
Exactly.
you can let them know that you have an investment advisor too. But
Exactly.
they
Yeah.
it's hard to know, because they are the, I would say, like how they have taken over that entire work retirement plan
I know
um
it.
area. Like all like every employer, from a hospital, from a to a manufacturer, to what I'm saying, a law firm, to everybody's using them now. Like they must like almost give it away for free,
Yeah.
because think about the number of assets they get access to.
Right.
Like when they know exactly when the person's about to retire. They get the notice, they get to plan, they get, so they're
Mhm.
getting, a tremendous amount, of business by managing all of those 401ks. But at the same time, um, I think that it needs to be something that needs to be looked at by regulators, because are investors, you know what I mean, really getting the options that they're supposed to? Because I see some companies and they'll have like the best of Fidelity's options, and some employers have the bottom of the barrel
Yeah.
of Fidelity's options. So, and this, I'm like, how do they choose? And some will have 10 options, and some people have 50. You know what I'm saying? Like they have like everything. It's amazing. Like
Yeah.
how, like, and then some will have like, it'll say Fidelity, but it doesn't have Fidelity funds in there. They'll have a whole different, mutual fund family in it. So they're just managing it, but they don't have, their own funds in it. So that's interesting. That
Yeah.
if I had like, if I could bring 5 clients, all of y'all together in a conference room, y'all look at your Fidelity statements and all of them be different. That is amazing. So those definitely, it's good, got to stay on top of it just like you're doing. And I would like to interested to see like that based on what, because it actually, if you made moves like based on that, you know what I mean, and slowed down your future, would they compensate you for that 20 years from now? Like,
Of
you know what I'm
course
saying? Like
not.
if you said,
Right.
if I had
Yeah.
stayed that, then you know what I mean, I would have had this, versus you told me this, like, how can a piece of paper be licensed to tell you those type of things?
Yep.
It's scary. Yeah, interesting. Any other questions before y'all go? Amazing. I just think it's amazing how much that we can accomplish. You know what I'm saying? look, we're gonna save all our comments to the end, right? y'all being all quiet. That's just it. Yo, was someone gonna say something? Cause you good? And I'll look, like we had like 13 good chats, but mostly from y'all just being so complete. I was playing all the hits. Exactly. Oh, Dr. Bambi, she's in Atlanta. Oh, that's great. Thank you, Ms. Muhammad, for inviting Dr. Bambi in. I love it. I gotta say Dr. Bambi because nobody ever hears Dr. Bambi. You know, you're one of a kind. But this Miss Hayes, that's your cousin. She's Dr. Bambi Hayes.
I see.
I know that's right. And that's so good. How you doing, Miss Davis? Yes, indeed. Well, I appreciate y'all. I heard you laugh, Reverend Bozeman, and that's enough. And Queen Howard said your message was great.
Oh, thank you.
Yes, indeed. Indeed.
Thank you.
Miss Davis, I don't think so. Someone specifically you know that you never know. Oh, I see. I did. I just got you. I got you.
Okay.
Yeah.
I have a question for you, JB.
Sure.
On the 401k, somewhere I do recall having seen something that says, click this if you want automatic rebalancing of your 401. I don't think I've ever done that. Can you kind of speak to that just a bit?
Definitely. And I'm glad that's a great example. I'm glad that we talked about, see what they're saying, that if you said, like I set up your allocation and it's really, if you don't have an advisor, this is how they're trying to get you to help the machine help you. So we said, I want this fund 20%, this fund 30%, this fund 45%, and this one, the balance of it, say 15%. And then all of a sudden that 15 becomes 25 because that fund did well, and that 45 becomes 30. Rebalancing will sell out that 15 that went up, get it back to 15, and take that that extra and buy the other one and bring it back up to 45. And the other ones might be still the same. And so if you want to do that automatically, sell off your winners and buy the losers, the computer will do that for you. But my argument is that it's real hard to allow that to be automated, because if you look at your statement and you go, wow, what in the world happened? They were doing great. You know what I'm saying? Like, and it continues to do better and you just sold out. You might not be happy. But if the person clicks automatic rebalance, then they need to be committed that that's what they want to do. When something overperforms, basically, you know what I mean? They want to get rid of it and go back, and purchase the loser. Because they're basically,
Again, no, I never did it because I wasn't really sure what I was doing. And that was one of the times I said, okay, let me pass on this because I'm not really sure what this is all about.
So they don't explain to you what they're doing?
No, they just say rebalance. If you click it, and you don't know how many people who are paying fees on their retirement accounts now, Reverend Bozeman, that would have never been heard of back, when you were actively in your 401k, that they'll allow them to put a machine on that says it's an investment advisor. And they never have talked to an individual person. But because it sends them a performance report, and it'll, basically a statement, and tells them a projection of what they'll have if they keep selling, saving at this rate, at this amount, then they charge them a fee. I think that is like amazing, and if you sign up for it, it will also, in many cases, include rebalancing automatically. So we have to be, very careful about these things. And once you get into AfroEconomics and I, start looking at the statements, I really try to make sure I, am looking for stuff like that. Because once you have an investment advisor, you don't have to pay an advisor also. Like, you don't have to do that extra fee. And generally the membership is cheaper than what they're charging on your account. So
one other thing, JB, can you talk about the target date funds? That's something else I've never messed with because I don't really understand that. I'm not sure what that's all about, but there'll be like, it'll be a certain fund name, then it'll say 20, 25, 20, 35, 20, 40. What is that all about?
They're for a person who doesn't want to choose the individual funds. So if they choose 2050, theoretically, they're saying, I want this machine to set up a portfolio for someone that's not going to touch this money until 2050. So it will automatically say, well, then you want a lot of stock. You want a lot of equity because you've got 30 years for this money to grow. So, they're saying that you're growth oriented and that you do have a pretty high risk tolerance. And then the 2040, the 2030, and the 2020 is for someone who is already retired, basically. And they might have picked it 20 years ago, but it was just to help someone choose something other than just sit there and cash or not, or do something way out of line. So I'm happy when I see someone that at least did that, like based on when I'm going to retire, I did this portfolio. Like that is helpful because at least they're thinking like they have a strategy. But what happens is they are saying that the closer you get to your retirement, the less growth oriented you want to be. So they're adjusting the portfolio automatically for you, which might not be relevant to you individually. So that's what I do. Like when we're doing our regular meetings, we're analyzing, did this change? Did anything change? So we don't have to have the portfolio changing for you or assuming. Basically, it's assuming that the closer you get to your retirement date, the less growth that you want. Like as if you retire, like that, you don't want stocks in it anymore. Where you might retire, but you still, might want it to grow. Or you still, you still need to have your individual needs met. But I can't complain that it's like the worst thing. It's not by any means the worst thing that an investor could do. But if you have an advisor, you shouldn't have to be in something like that because they should be helping you outperform. That's my goal, to outperform the 2050 for you.
Okay, thanks.
Right. Oh, no, thank you. Great question. Great question, because I think it's a good risk management question because that they're doing that to try to help the employee manage their risk using the computer. So it's definitely, and Ms. Davis said, JB's going to make me a millionaire by the time I retire with my retirement account. And Ms. Davis is young, so we're shooting for multiple millions, girlfriend. Multiple millions, exactly. and you can do it. I know you can. That's right. Yes, indeed. I can only do it, but you all do the hard stuff. You go to work and you sacrifice and you save. That's a blessing. But thank you so much. What's got? Oh, Rosita put the money bag. That's right. And you too, little girl. You too. I appreciate y'all. Great questions. And we're good.
Yeah.
Right. Oh, that's so good. It's so great. Y'all are just blessed. You're blessed. And now you're on point. And then, remember, the key things that we talked about, you're very welcome, that you need to make sure that we're talking regularly. And if anything came up into your mind and you said, oh, I got to talk to JB about it, please make sure that you call, the office now. Leave the message while you're thinking about it, or email me now while you're thinking about it. Don't wait till later. And definitely, Ms. Stembridge, we need to, talk and catch up. And but I appreciate y'all.
Thank
Enough.
you, JB.
Thank
Have a
you.
good night.
Thank you. Oh, you have a good night. Oh my goodness. My little new jack just popped out. That's the new jack. I said, what happened to Tevin Campbell? We gotta find him.
Good night.
I looked him up, but he said he's an actor now, but I haven't seen him in any movies. So I will tell you, remember next week is my birthday party. So March 10th, Founders Day, and my birthday. We're gonna have a party next week.
Woo,
Next
woo.
Good.
Love
Be
it.
ready. Be camera ready. Be camera ready. Be camera ready. I know. Look, Mr. Richardson said, "Girl, you better take your night off." I said, I know. I'm gonna take. Look, I'm not gonna work Tuesday night, but we're gonna. I mean, and it's a party anyway. I promise it won't be just work. We're gonna party next Wednesday night. So
All
if you
right.
have time, be camera ready, because I want y'all to come on camera and let's celebrate Founders Day. I've started the firm on my birthday.
Wow.
So we have twofold. Yes, I've been working on my birthday from the beginning, right? Reverend Bosu.
Yes, you have.
It's nothing
And we
new.
really appreciate it.
Oh, and I appreciate you. Yes, indeed. So next week we can talk about legacy. That's what we'll do. Legacy, passing it on, building it, leaving that footprint in the sand. We're gonna do it. Have a great one, y'all. Good night now.
Good night.
Good night.
Night.
Good night.
Good night.
Good night. Good night.